The world of global energy is in a state of rapid transformation. The traditional powerhouses of energy production and consumption are facing unprecedented challenges and opportunities. This shift is not just about the sources of energy, but also about the geopolitical and economic landscapes that underpin them. Old alliances are being tested, and new partnerships are emerging. Countries that once relied heavily on established energy routes are now exploring alternative pathways to secure their energy futures. This dynamic environment is fostering a new era of collaboration and competition. At the heart of this shift is a resurgent trade war, ignited by the re-elected U.S. President Donald Trump. His administration's aggressive stance on trade has reignited tensions with major global players, particularly China. The ripple effects of these policies are being felt across the world, especially in the energy sector. This new wave of protectionist policies has sent shockwaves through the global energy market, leading to unexpected alliances and a scramble for energy security. The volatility in oil prices and the uncertainty in trade relations have made it imperative for countries to reassess their energy strategies. The catalyst for this seismic shift was the imposition of tariffs by the United States on a range of goods from China, Canada, Mexico, and the European Union. These tariffs have not only strained diplomatic relations but also disrupted the flow of goods and services, including critical energy supplies. These tariffs, a cornerstone of Trump's America First policy, have upended decades-old trading relationships and forced countries to seek new economic partners. Nations are now looking beyond their traditional allies to forge new trade agreements and secure their energy needs. The energy sector, being a cornerstone of the global economy, has found itself at the epicenter of this trade war. The disruption in energy supplies has prompted countries to diversify their energy sources and invest in new technologies to ensure a stable and reliable energy future. With traditional energy flows disrupted, nations are now looking for new sources of energy security and reliability. Renewable energy projects such as wind and solar farms are gaining traction as countries seek to reduce their dependence on fossil fuels and mitigate the risks associated with geopolitical tensions. This has led to a fascinating new development: the emergence of a powerful energy alliance between China and Canada. This partnership is not just about energy, it represents a strategic realignment in response to the shifting global trade landscape. Both countries are leveraging their strengths to create a more resilient energy network. This unlikely partnership, forged in the crucible of economic uncertainty, has the potential to reshape the global energy landscape. By combining their resources and expertise, China and Canada are positioning themselves as key players in the New World Energy Order. It also underscores the profound impact of Trump's tariffs on reshaping global trade and forcing countries to rethink their energy strategies. As the world navigates this complex and evolving energy landscape, the alliances and policies formed today will have lasting implications for the future of global energy security. In 2025, the world witnessed a return to protectionist trade policies, a shift that many had hoped was a relic of the past. The global economy, which had been gradually recovering from previous trade tensions, was once again thrown into a state of flux. The U.S., under the leadership of the re-elected Donald Trump, imposed tariffs on a multitude of goods from several key trading partners. This move was part of a broader strategy to bolster domestic industries and address long-standing trade imbalances. This decision marked a significant escalation in trade tensions and ignited a trade war with global implications. Financial markets reacted swiftly, with stock prices plummeting and investor confidence waning. The ripple effects were felt across the globe, from Asia to Europe, as countries braced for economic turbulence. The tariffs, a key element of Trump's economic agenda, were aimed at protecting American industries and reducing the trade deficit. Factories across the United States ramped up production, hoping to capitalize on the new trade barriers that made foreign goods more expensive. However, they have been met with retaliation from countries like China, Canada, and members of the European Union who have imposed their own tariffs on U.S. goods. This tit-for-tat strategy has led to a complex web of trade restrictions affecting everything from agricultural products to high-tech components. This tit-for-tat exchange of tariffs has created a climate of uncertainty in the global market, disrupting established trade flows and supply chains. Companies that relied on just-in-time delivery systems found themselves grappling with delays and increased costs, leading to empty store shelves and frustrated consumers. The energy sector, being heavily reliant on global trade, has been particularly vulnerable to these disruptions. Oil refineries and energy infrastructure projects faced delays and cost overruns as the price of imported materials soared. The tariffs have had a cascading effect on energy markets. Fluctuating oil prices became the norm as traders struggled to predict the impact of the ongoing trade war on supply and demand dynamics. Energy market analysts worked overtime to provide insights, but the volatility made accurate forecasting nearly impossible. For instance, the tariffs on Canadian steel and aluminum have increased the cost of building pipelines in the US, potentially hindering the transportation of oil and gas. This has raised concerns about the long-term viability of critical energy infrastructure projects. Similarly, tariffs on Chinese solar panels have made renewable energy projects in the US more expensive. The push for green energy, which had gained significant momentum, faced new financial hurdles as the cost of solar installations rose. The return of protectionist trade policies has injected volatility and uncertainty into the global energy market, forcing countries to reevaluate their trading relationships and seek new avenues for energy security. International energy summits have become critical forums for discussing these challenges, as nations strive to navigate the complexities of a trade landscape that is increasingly fraught with tension and unpredictability. In a surprising turn of events, Canada and China, two countries with vastly different political systems and economic structures, have found common ground in the realm of energy. This unexpected alliance, forged in the face of US protectionism, has the potential to reshape global energy flows and challenge the existing energy order. The cornerstone of this new partnership is China's growing appetite for energy and Canada's abundant oil and gas reserves. With US tariffs making Canadian energy exports to the US less economically viable, Canada has been actively seeking alternative markets. China, on the other hand, is eager to diversify its energy imports and reduce its reliance on traditional suppliers in the Middle East. The convergence of these interests has led to the signing of a significant oil pact between Canada and China. While details remain scarce, the agreement is expected to involve a substantial increase in Chinese imports of Canadian crude oil and liquefied natural gas, or LNG. This burgeoning energy partnership is a testament to the shifting sands of global trade in the face of protectionist policies. It also highlights the pragmatism of both Canada and China in prioritizing their respective economic interests and energy security. The Canada-China Energy Pact is more than just a political agreement. It's underpinned by concrete infrastructure projects that are set to facilitate the flow of Canadian energy to Asian markets. This agreement marks a significant milestone in the energy sector, reflecting a deepening of economic ties between the two nations. The collaboration is expected to not only boost Canada's energy exports, but also provide China with a reliable and steady supply of natural gas, which is crucial for its growing energy needs. One such project is the LNG Canada facility in Kitimat, British Columbia, a massive undertaking that is poised to become a key conduit for Canadian natural gas to reach China. This facility represents one of the largest private sector investments in Canadian history, with an estimated cost of $40 billion. The project is a joint venture between several major energy companies including Shell, Petronas, PetroChina, Mitsubishi Corporation, and Kogas. The LNG Canada project, scheduled to commence operations in mid-2025, will liquefy natural gas, allowing for its efficient transportation by sea. The liquefaction process involves cooling the natural gas to -162 degrees Celsius, transforming it into a liquid state, which reduces its volume by 600 times. This makes it feasible to transport large quantities of natural gas over long distances, opening up new markets for Canadian energy. This is particularly significant for Canada, as it provides a vital link to Asian markets, allowing it to overcome the geographical constraints that have traditionally limited its energy export options. The strategic location of Kitimat on the west coast of Canada offers a direct shipping route across the Pacific Ocean, making it an ideal gateway for energy exports to Asia. The project has also attracted significant investment from Chinese companies, further cementing the energy partnership between the two countries. Chinese investments are not just financial, they also bring technological expertise and market access which are crucial for the success of such large-scale projects. For instance, Sinopec, a Chinese state-owned energy giant, is reportedly considering a stake in the Cedar LNG project, another LNG export facility proposed for Kitimat, which is expected to be operational by 2028. The Cedar LNG project aims to leverage the existing infrastructure and expertise developed through the LNG Canada project, further enhancing the region's capacity to export natural gas. These LNG projects offer a compelling logistical advantage for China's shorter shipping times. The proximity of Canada to Asia compared to other major LNG exporters means that shipping times are significantly reduced, which translates to lower transportation costs and faster delivery times. Transporting LNG from Canada to China takes approximately 10 days, significantly less than the 20 days required to ship it from the US Gulf Coast. This efficiency not only benefits China, but also enhances the competitiveness of Canadian LNG in the global market. The reduced shipping time means that Canadian LNG can reach Asian markets more quickly, providing a reliable and timely energy supply to meet the growing demand in the region.